What happens as the depression worsens? Businesses can't pay their debts. The bad losses fall on the banks. The banks ultimately fail. That's happened before. The Fed's there to bail out the banks. What happens when the Fed itself is in jeopardy?
Based on these signals you've been tracking, the Federal Reserve is going to fail?
The Federal Reserve actually in some ways already has failed. I spoke to a member of the Board of Governors of the Federal Reserve, and I said, you know, I think the Fed's insolvent on a mark-to-market basis, and this governor first resisted, said, no, we're not. But I pressed her a little bit harder, and she said, well, maybe. And then I just looked at her, and she said, well, we are, but it doesn't matter. In other words, here's a governor of the Federal Reserve admitting to me privately that the Federal Reserve is insolvent, but said, you know, it doesn't matter because central banks don't need capital. Well, I'm going to suggest that central banks do need capital. Look at this chart. What it shows you is that the Fed has increased its capital. It's currently about $56 billion. That sounds good. You say, gee, $56 billion is a lot of money. That's a pretty good capital base. But that's not the whole story. You have to compare the capital to the balance sheet. How much in the way of assets and liabilities is that amount of capital supporting? When you look at that, it's a much scarier picture because the actual liabilities, or debt, if you will, in the Fed's books are $4.3 trillion. So you've got $4.3 trillion sitting on this little skinny capital base of $56 billion. That's very unstable. Prior to 2008, the leverage was about 22 to 1, meaning they had $22 of debt on their books for every $1 of capital. Today, that leverage is 77 to 1. So yes, the capital has increased, but the debt and the liabilities have increased much more.
Your warnings haven't gone completely ignored. In the budget he presented this year, Senator Rand Paul cited your work and how we've driven our economy to the edge of a Roman Empire-like collapse. In fact, we have footage of Senator Paul instructing Americans to listen to your warnings.
Jim Rickards, author of Currency Wars, notes, the Fed is insolvent on a mark-to-market basis. The Fed has wiped out its capital on a mark-to-market basis. Of course, the Fed carries these notes on its balance sheet at cost and does not mark them down to market. But if they did, they would be broke.
First of all, I give Senator Rand Paul a lot of credit. He's one of the people who understands the dangers here. But the problem is not limited to the Fed. It's infecting the private banking system as well. There's about $60 trillion of debt on the balance sheets of our banking system. For a long time, debt in the banks grew at about 2 times the rate of growth in the economy. But lately, this has exploded. Today, it's up to 30 to 1. In other words, for every dollar of economic growth, there's $30 of credit being created by the banking system. The whole thing's unstable. I can give you a very good example of this, and this actually comes from physics. If you had, let's say, a 35-pound block of uranium shaped like a cube, it would actually be fairly harmless. It's what we call subcritical. It's radioactive, but it's kind of tame. But now imagine you engineer it. You take that 35-pound block, you take one piece and shape it into something about the size of a grapefruit. Take another piece, shape it into something like a bat. Put the ball and the bat in a tube and fire them together with high explosives. That sets off a nuclear detonation. That destroys a city. The way it's been shaped and configured is what takes it from what we call subcritical to supercritical.
Jim, are you seeing any signs that our stock market has reached a supercritical state?
Well, unfortunately, yes, we're seeing a lot of signs of this. One of the ones that's really fundamental and really important is the ratio of stock market capitalization to GDP. Because you remember, the value of all the stocks in the stock market, that's supposed to represent the fundamental economy. It's not supposed to be off in a world of its own. But if you look at what's been happening to that ratio recently, it's going sky high. It's 203%. Prior to the recession, that number was 183%. Go back to the famous tech bubble, the dot-com implosion of 2000. At that time, it was 204%. And if you want the scariest news of all, just prior to the Great Depression, that number was 87%. In other words, the stock market capitalization as a percentage of GDP is twice as high as it was just prior to the Great Depression. So that's a really good metric for saying, hey, is the stock market heading for a crash? All the data says, yes, we are. But there's another metric, another warning sign, if you will, that's even more frightening, which is the gross notional value of derivatives. There's a certain number of shares of IBM that are outstanding, but we know what that number is. But there's no limit on the derivatives. I can write options and futures on IBM stock all day long and all the other stocks on the stock market. And that's what's been going on. Now, the gross notional value of derivatives in the world today is over $700 trillion, not billion, 700 trillion. That's 10 times global GDP. This collapse is unavoidable. So, we ask ourselves, how bad can this be? Well, what happened in 2007, 2008 when the markets collapsed? We all remember the value of stocks going down, real estate going down, housing going down. All that lost wealth was $60 trillion. The problem is now the system is bigger, so I would expect the lost wealth this time to be $100 trillion, possibly a lot more. We're in this critical state, getting close to the supercritical state where the system implodes.